Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you the afternoon of the 30th of July. This is our July 2024 video. I hope you enjoy it. Let's begin, and I will share the screen, and here we go. So, as you can see, we're calling this Having Fun in the Sun, and we've got some beautiful photographs of various different locales and summertime, all great. But you know what, folks? It's not always sunny, it's not always calm, it's not always wonderful. And we, as your fiduciaries, as those who are focused on making sure our clients are served, we're worried about the following. We're worried about storms. We're worried about what's going to happen next. And to that regard, we are allocating capital carefully as we see the concerns, as you'll see in a moment. So it's a balancing act. Sure, there are some exciting things happening in the economy and the markets, perhaps interest rate cuts, perhaps, AI continued growth, who knows? But suffice it to say, we are priced to perfection. Valuations are stretched. And as we all know, things can go awry. So as your steward here at ALINE Wealth, we are always worried, always watching for what could happen next and what could cause a storm. We want sunshine, don't get me wrong, we love it too. We worry about the storms. Okay, let's start with market internals. Here we're talking about cash on the sidelines. And this is important because everyone's in the pool. As you can see, we're at a record low of having cash on the outside of the compared to market values. And that's a little worrisome, although it's a big number, even at these lows, it's still a big aggregate number, the value of cash on the sidelines, but it's at records lows compared to what the market value of securities are. And that gives us some pause. We're saying here, everyone's in the pool. You see that? Pool, summertime, you get it? But the point is that when everybody's in the pool, what happens when, markets come down and the marginal buyer doesn't have the fuel to do so, ergo doesn't have the cash to do so. So that's what gives us some concern. And the other thing is, when everybody's in the pool, lots of big waves can happen from just little waves. So let's be careful. This also sticks in our craw a bit. Top 6 stocks in 2024, accounting for a serious amount of the returns. And when we see that, it is not great. Well, I'm glad to see the breadth narrowing, that the other 494 stocks are picking up. And that's good, but this is outsized. And when you see something that's outsized or an anomaly, my antennas go up and say, time to be careful. Same kind of thing here. This is the number of S&P 500 stock, the percentage of the S&P that's outperforming. It's the lowest level in 5 decades. So it's just a handful that are running, and everybody else is sort of just going sideways. Now, there are opportunities that we take advantage of in those sideways movements, uncovering the rocks to find the gems, if you will. But suffice it to say, narrowness. And to further belabor the point, here's another graph that shows us the narrowness of the market. And here we're seeing how the top 5 stocks are now 30% of the S&P. Now it's like a flashing yellow light of caution. Now, this is helpful from Ned Davis. Thank you. This is helpful because it shows us in the past, when we've had this type of setup, what typically happens. And here you'll see that 126 days later, from when the growth value ratio performance is below 30%, you'll see what happens going forward, and it's not great, right? So this gives us some pause to say, hey, well, wait a minute, we've seen this movie before, and when we dial it forward, typically we're not looking at great returns on the median and the number of percentage positive. Okay, valuation is a big part of what we do, a big part of our work, and so let's get into it. On a cap-weighted S&P, which is the typical S&P, is 30% more expensive on a PE basis, right, than the equally weighted. So I want to unpack this for you. When we quote the S&P 500, we quote it typically as it's shown as a cap-weighted index. In other words, those high cap stocks have a bigger weighting. In fact, we just saw six of the 500 stocks have more than a 30% weight. So when we see that kind of unusual weighting, that tells us something. But moreover, we can now look at the PE, the valuation of that cap-weighted S&P versus the equally weighted S&P, which is 500 stocks, 1/500th of a weight for each one. And you can see here, the cap-weighted index, owing much to those few stocks, are trading at a 30% premium versus the equally weighted. What equally weighted S&P, you should think of that as being the average stock. So the S&P, or I should say the handful of stocks in the S&P that have really caused this are trading at a substantial premium to the average stock. Curious. Typically, if I were to say to you that the lowest yielding or no yielding S&P stocks, the dividend yielding, have done better than those that have a 1 to 3% dividend yield, you'd think that'd be surprising. Typically, you'd see the opposite. Typically, you would see that the higher yielding stocks do better because they have dividends, they're safer, they're able to pay these dividends. Many times they pay these dividends for many, many years consecutively. The aristocrats, the dividend aristocrats, as they're known. And typically when you have a dividend, you're known as a safer equity, right? Because you're able to have sufficient cash flow to do your business, to grow your company, and to pay out a dividend. But yet it seems like those stocks that have no, or some small amount of dividend yield have outperformed in the second quarter, year to date, 2023, consistently. Now, they also got slammed a bit more than the other sectors here, the other deciles, quintiles, but absent that, they've went up a lot in the last 2 years. So this is an interesting, curious statement. And you can see here the PE. So the stocks that are trading with dividend yields at a 15 price to earnings ratio, which is considered low-ish, have underperformed the stocks that have traded at a 27 times PE with no dividend yield. Curious. And without low interest rates to rationalize this move, growth is consistently outperforming value. Now, you could understand that back in the days here where you would see low interest rates. But when rates are back to where they are now, to a point where they're no longer ultra low, it's hard to understand why the PE premium for growth is so much. Now, we're always on the lookout for ideas. We're always on the lookout to provide investment solutions to our clients that balance the need for return with the need for risk mitigation. So where are we finding these opportunities today? This is our playbook. We're overweighting cash and underweighting fixed income. We don't believe that the bond bull market of the last 40 years, except for the last 3 years, is back. We believe it is a sideways at best market going forward. So, again, notwithstanding some opportunities, perhaps in short-term municipal bonds or the like. But for the most part, we don't think that the fixed income sector is super exciting. So therefore, we're keeping our powder dry, our dry powder in cash. Why? No risk, right? You're getting a 5% return on that cash with no risk and instant liquidity, which leads to the notion of optionality, giving us the ability to put that capital to work quickly when opportunities arise. And so we're getting paid handsomely for it, probably better than we would get in fixed income, and we don't have any risk. And we have optionality and quick liquidity. So that's why we're overweighting cash, except also because it's a ballast to the portfolio. It's the only asset that doesn't go down, right? So it will become the ballast for the portfolio. Dividend growth, value, high free cash flow yields. These are the types of things we screen on. We like sectors that are inflation centric, like real assets and precious metals, infrastructure, resource companies, companies with pricing power. And of course, we love the water sector. This is shows us how high yielding sectors, again, much to what we were talking about before, have significantly underperformed the S&P, and how there's a compelling opportunity in these out of favor asset classes like consumer staples, healthcare, utilities, and telecommunications. They've gone, as you could see, straight down in the last couple of years, especially in the last year, and thereby providing strong dividends, dividend yields, and cheap valuations, which was another way of saying a margin of safety. That's the term that was used in Graham and Dodd and by Buffett. Is margin of safety. Is you're buying a security, an investment, a sector whereby you're buying it, so low or so discounted on a valuation basis that gives you a margin of safety, whereby if it were to go lower, you still, how much lower can it go kind of thing, because it's already cheap. Now, Professor Schiller of Yale had done some work called the CAPE. And what he did was he took the PE ratio and he cyclically adjusted it, which means he used it over a 10-year period so that he could sort of factor out or smooth out the business cycle impact on those price to earnings ratios, or more likely on the earnings side of the PE. So it's a smoother. That's what this CAPE is, basically a smoother. And it shows us, not a spot in time, but over a period of time. It's a very good measurement of valuation. This slide speaks to the CAPE, the Schiller's price to earnings ratio, or the CAPE, on the MSCI EFA, which is the developed international markets, versus the S&P 500. And as you could see here, it's been US all day since '08. Maybe we came out of it faster. We did. We definitely were more aggressive with our ZIRP, or zero interest rate policies, and our buying of bonds, QE, and all of that. We were more aggressive, and that caused, and we have more tech stocks in our S&P than the international markets have. But guys, this is 15 years in the making here, and this has gone on. Look at this. So when you see that kind of gap of valuation, just cyclically adjusted valuations, it's telling you something. Much like this told you something in the 80s, right? And here comes the S&P roaring back versus the international markets. So we think this is telling, and that there's an opportunity to be had in the international markets, less risk, and potentially a future glide path of higher returns. Same sort of scenario here, as you can see, deeply discounted levels, international versus US, which leads to opportunities post these deep valuations. Now, this is the Russell Value Index versus the Growth Index. And here again, so here we're looking at US value versus growth. And here again, value has gotten, they had a bit of a jump in 22, but since then it's been coming in a bit. And we think there's an opportunity to be had in the value style domestically. This slide, real intriguing, and it shows the S&P versus value. Now, when we sort of look at value in the S&P, you have to sort of bifurcate it and look at where is value in the S&P, because the S&P 500 is a big index, and it's more skewed towards growth. So what they do here is they look at the bottom 20% of the S&P by price to earnings ratios, and they consider that segment, that quintile of the S&P, to be the value proxy because there are lower PEs, right? Which makes sense. And then they annualize those returns from January 1st, 2000. So that's our starting point. So for the 10 years starting January 1st, 2000 to 2010, the S&P was flat, let's call it. But look at the value segment of the S&P. Now remember, you're coming off of the dot-com crash, right? So the S&P is flat for 10 years, the lost decade. And here we are with the value proxy of that same index up almost 11% for the period. Here is an annualized, so that's annualized return for 10 years. Over the 5-year period, so 2000, 2005, the S&P was down 2.3% per year on average. Value of the value segment of the S&P up 17%. And over the 2-year period, then you had Enron in here and such. Again, the S&P down 17%. This incorporates the dot-com crash and into the whole Enron. But look at the value segment. It's up 20. I mean, so it's really compelling when you have these inflection points, and you can look at value as a great place to sort of look at going forward. Copper has been something on our list for a while. We believe that with the electrification theme strongly in play, that copper is going to have an important part of that. Clearly, you can't build electric anything without copper, and nor can you build a data room without copper. So copper becomes an interesting AI play with a lot less risk. This shows you the production and how it's come down. And largely it's come down for years. It hasn't gone up very much for years, largely due to ESG constraints and regulatory constraints. So with low production equaling low supplies, increasing demand due to electrification and AI, data room build out should increase the price substantially. This is energy. Energy is now near COVID lows as a percentage of the S&P 500. This provides, I think, an opportunity for today's investors. And not only is it cheap relative to the sector weightings, but we're finding some really interesting companies. We're overweight in energy, and we're finding some really interesting companies with great fundamentals, great free cash flow yields, and solid dividend growth. But we've got concerns, and that's what we do. We worry. We worry for our clients. We worry about their portfolios. We constantly sort of stress test them in our minds and in our committee meetings. And we try to make sure that we are not missing something and that nothing's going to come out of the blue to haunt us. So our concerns, I was going to say this one, the federal debt as a percentage of GDP. Check this out, guys. This is in 1947 when we saved the world from tyranny and fascism, and we're coming off the World War II. And at that time, in 1945, 16 million people, men in the United States, older than 14, were sort of on the payroll. So of course you had a massive deficit. No one's producing, everyone's on the payroll. And obviously we go through the next 60 years, 70 years, and look where we're at. And yet we're not fighting a domestic war. So this is worrisome because it's a lot of money, 35 trillion now, and now it's becoming expensive to service it. And as you can see here, we're getting to a point where and the projections are even higher, where it's becoming really expensive to service this debt. And that has big implications to interest rates and big implications to this idea that inflation is going to become tame. I don't think so. And concentration is another big risk of ours. Going back to the nifty 50 period of the early 70s, we're back there again with 34% of the S&P represented by just 10 stocks. Very similar to that, as you can see what happened since then. And what this means is essentially is not that the market's gone down so much, or it did a little bit here and there, but what this is saying is becoming less concentrated, right? And it's becoming less index based and more, and those with a high active share, those who are stock pickers per se, are going to outperform in this period, where those who are in indexes don't. And then the opposite happened here, where everything was indexing and passive, and just throw a dart against the wall and buy the biggest cap weighted stocks. Well, I think we're going to be on the other side of that. And largely because of this, the regime change. And we've talked about this time and time again, but since 1982, we've had the greatest bull market in bonds ever known, where the 10-year bonds gone from 15 to 0 essentially before COVID. And that annual return of the S&P, because it was fueled by these ever reducing interest rates, was 11.8%. In the prior regime from World War II to 82, we've seen half of that as a return because interest rates are going up. So that's sort of, wind at your back, wind at your face. Where's it going next? I think it's probably going to be less of this. However, if you think you can time the market, think again. We always try to end on this. This is a great slide. It shows you the hypothetical growth of $10,000 in the S&P 500 for the last 40 years, ending in 2020. And if you just did a Rip Van Winkle of 40 years, your 10,000 made $952,000. However, if you thought that maybe the market was going down or interest rates were going up or geopolitical, who knows what, and you said, I'm out, and you got all out of the market. You didn't balance, you went a one-sided bet, and you took money out completely, and you happen just to miss 5 of the best days, because you don't know when the best days are, you went down to 38% from where you could have been if you were just buy and hold. So I think the answer to this is not to sort of buy and hold. I don't know if that's the right answer. I think the answer is more of a balance, where maybe you see markets going a little haywire, you pull in a little bit. And when things are deadly and scary and bloody, you go in a little bit. It's this working the edges, I like to call it. And that's what we do as professional active managers of your assets. But it's not the only thing we do. We're there to talk with you about your portfolio, talk to you about the values you want to have, the values you want expressed in your portfolio. We talk about your family situation, your estate plan, your financial plan. This is what wealth management is. It's communicating with our clients and always putting clients' interests first. Thank you. Have a wonderful rest of the summer. We look forward to catching up with you next month. Thanks.